All right, getting started. So, y'all are getting ready to make your rank order lists. I'm going to tell you up front that you need to understand benefits packages are not the be all end all of where you should go work and how you should do your rank order list. But that makes a really good tiebreaker if you're like, I've got number one, two, and three, but four and five are about the same. How can I differentiate? This is where the benefits package is going to come into play for you. It's also going to help you understand, like, as you're ranking one, two, and three, you need to double check though, can I afford it based on what they're going to charge me for my benefits? Because now all of you are going to be off paying for your own benefits, own health benefits, vision, other insurances, and things like that. So we're going to dive in. We're going to start talking about just kind of the basics of insurance: health, dental, vision, kind of the big three for that. We are not going to talk about disability insurance today. That's a whole nother talk, and you'll get that one in March. And after we get through the insurance section, we'll pause for questions. Then we're going to jump into things like HSAs, FSAs. How do you take a vacation? How do you take sick leave? For all of you, it's been like 4 years since you've had to think about it. Some of you have never had to think about it in terms of like full-time job before. So we'll talk about that and how that works. What other benefits are there out there? And this data that we're using today comes from a survey that the AAMC periodically does of residency programs. So this is straight from the residency programs, at least the ones that answered, and what they say they offer. And then we'll have another round of questions. All right. So why are you here? You're here to understand benefits better. You're here hopefully to kind of do some of those tiebreakers and at least understand and translate what they're giving you in those packages or they're talking about on interview days. Should take about 45 minutes. And then other upcoming events you need to keep an eye out for. Exit counseling sessions. You've already had an email from me about that, just to keep an eye out that second email is coming. We want to do those after your match day. So we want to know where you're going before we're doing your exit counseling, because that could change your loan repayment entirely, just based on where you end up doing that residency. If it's for profit, if it's not for profit, it's going to be a big question we need to ask. How much is housing going to cost? We need to have some of that figured out. We're going to do a guide on public service loan forgiveness, which we will also do after the match and after we've done most of your exit counseling sessions. That'll usually be a lunchtime thing closer to April. And I forgot to put it in here. You can see the nice open space there. On March 15th, so during match week, we actually have someone coming in to talk to y'all about investing and managing your money during residency. He's going to focus mostly on the investing side and on the what should you be concerned about then, how does tax structure going to change as you go through, and does a really good job and is great for answering questions. He'll also give you the chance to set up some individual meetings if you want to do that at no charge for you. If we're able to do that in person, which is my hope, I will feed you all lunch, and it's usually a pretty good one for that one because it's a required meeting. And if we're in person, we'll set him up in one of the study rooms on the third floor to be able to go and meet with y'all, and he'll be here for like 2 days usually for that. All right, diving into it. First things first, I always like to start with definitions just so we make sure we're using the same words the same exact ways when it comes down to this. And for the most part, these are going to hold true for any insurance that you're offered, be it dental, vision, or healthcare insurance. So the first one, your premium. These are your monthly payments. For some of us, it's like I pay like $300 a month for my healthcare premium, and that covers my whole family. Some of you maybe will land somewhere where your premium is $0 a month. That's awesome. Some of you may land somewhere where it's a little bit more expensive, but for the most part, actually 99.9% of the time, they're going to offer you some sort of healthcare, and it's usually going to be pretty good. Next thing, what's your deductible? So deductible is always that weird thing that causes everyone some strain. You forget about it at the beginning of the year, and it's you have to pay a chunk of money first before your insurance is going to cover anything. Now, it doesn't mean you're paying full out of pocket with your providers. For the most part, they're still going to send it to insurance so that your insurance can count it against your deductible. But then they're going to reduce the cost of whatever it was they were charging you down to what we would call the allowable charge, which we'll get to in a second. Um, so you're still not going to pay the full out-of-pocket rates, but you're going to pay a lot up front for the first couple of doctor's office visits of a year. It's pretty typical. It happens. Right now we've been doing that right now because I've been to the dermatologist and you know urgent care and other doctor's visits and things like that. Towards the end of the year, we start worrying about out-of-pocket maximums and things like that. Where are we on that? All right, copay. You have to pay a cost just to step in the door. You may pay some more after that, but your copay is, hey, you've come to the doctor's office just for coming. Give us $15, give us $25. Heaven forbid it's an urgent care and you're on the student health insurance, and it's give us $75. So, of course, we want to avoid that when possible. So know what your copay is. These usually do not count towards your deductible. Some insurance companies will count them towards your deductible, others won't. Then there's the out-of-pocket maximum. This is the most important thing if you have an expensive healthcare year, is that if you hit your out-of-pocket maximum, the rest of your healthcare is free for the year. There have only been a few times in my life, at least 7 times around here, that we've hit our out-of-pocket maximum. And that's just the most you're going to pay in a year. So it's your worst case scenario for healthcare. So know what that is. Around here, we tend to hit those if we have a baby. Well, that's 6 of the 7 times. If someone has surgery, well, my son Christopher, when he was 1, ended up 2 surgeries, and we spent a month in the hospital with most of that in the PICU. Well, guess what? We hit our out-of-pocket maximum really, really fast because that happened in February. The rest of the year, everything was free. Guess who got all the health care that year? Everybody. If you hit out-of-pocket maximum, go get everything done that you've been putting off. Go to the chiropractor if they cover it. Go any and all visits that they'll cover. All right, next thing, allowable charge. This is what I hinted at earlier. This is what they as the insurance companies, consider to be the right price for things. It's actually usually a negotiated rate that they've negotiated with the doctor's offices or groups and things like that. And your insurance won't pay more than that allowable charge. Well, guess what? If the doctor's office still charges you more, you could end up having to pay more, but usually only if it's out of network. If it's in network, for the most part, this is the most you will be charged for a procedure, and that's what we were talking about earlier with the copay. You could get charged a little over the copay, say for labs or something like that. And the way this works is, you go and you pay your copay. It's $15. So you pay $15 up front. While you're there, they run a strep test or something like that. They run a COVID test. And what we're seeing most often, by the way, go get your COVID test for free. They're free places all over the place, assuming they still have some. Or you can get them at home now. But if there's a cost for something else in there, say the doctor's office normally charges $30, but the maximum allowable charge is $15. Even if you haven't met your deductible, you're still only going to get charged for $15 because it's the benefit of having insurance is they've negotiated lower rates on these things. Then we get into coinsurance. So we've talked about out-of-pocket maximum. The way you reach that out-of-pocket maximum is by paying your coinsurance. So you've met your deductible. You paid that whole amount. For us, it's like almost $500. For y'all, I think it's close to $700 if you're on the student insurance. So you paid that whole amount of your deductible. Now your insurance is kicked in. And for most of you, that's going to be 80-20, maybe it's 90-10, maybe it's 70-30, where the insurance is going to cover the larger portion, and you're required to pay the co-insurance of what's left of that charge. So if it's a $1,000 charge, allowable charge, insurance covers 80%, so they're going to cover $800. You're left with a charge of $200. Kind of how that works until you reach that out-of-pocket maximum. Then we have something called waiting periods. This is, for the most part, it's not going to affect most of you. Most of you will receive insurance coverage that starts on day 1, usually of orientation, so not even waiting until July 1st. And waiting period is if you have one of these, your insurance doesn't kick in until the end of a waiting period. One of the most notorious ones I ever heard, and I don't think they even do this anymore, was that like UPS, you had to wait 6 months, you had to work for them for 6 months before your insurance actually kicked in. So you had to maintain other insurance, whether under COBRA, which is really expensive, or under the Affordable Care Act insurance exchange, or some other way. Maybe people are still on parent insurance. For the most part, if you're going to have a waiting period, it's going to be about a 1 month waiting period. And if you're still on student health insurance, well, your insurance goes through July 31st. So you would actually be good on that. It would cover you through that waiting period. If it's going to be longer than that, or if you're on, say, turning 26 in May, or whatever reason you're not going to have insurance, you may need to get some sort of a gap insurance to cover that gap there. Then there's riders. You know, I like the joke. It's like Burger King. You can have it your way, but it is going to cost you. A rider is usually something extra you're adding to your insurance, and anything extra you add, like if you add avocado at Moe's or Chipotle, well, it's going to cost you extra. Insurances the same exact way. And then there's the two main types of insurance. So again, making sure we're all on the same boat here. An HMO basically says, go here or we're not paying. If you choose to go out of network, that's fine. That's on you. We're not paying, and we probably don't count it towards your deductible or out-of-pocket maximum. It's pretty good. They usually tend to cover a little bit more because they've entirely said. You see this actually a lot with hospitals. Hospital systems will set up an HMO where basically if you go anywhere within their hospital system, it's covered at a pretty good rate. If you choose to go outside, hey, that's your decision. You made the choice. You go pay for it. So you pay for the choice that you made there. A PPO is going to work a little bit different. It's a preferred provider organization. I forget what HMO actually stands for. But PPO is going to say, look, if you go here, if you go to these in-network places, we're going to pay more of it. We'll pay 80-20. If you go out of it, we'll still cover 60%. It's not as good. We want to incentivize you to go to where we're saying and where we have these contracts negotiated, because that helps us negotiate better contracts and cheaper rates. But if you choose to go outside, we'll still help you out a little bit. They don't tend to be quite as good. Now, this isn't 100% of the time, but they tend to cover just a little bit less than an HMO because there's a little less control there. All right. So what are you looking at in terms of trends? Based on the data, for the most part, like I said before, you're going to have insurance covered by the hospital system. Now, if you look at it, out of 186 responding programs to this, 50 actually fully paid for the residence coverage. Means you had no premium each month. The example on the right, and this is examples only because this information is a little bit old. They don't post everything online anymore. Unfortunately, it used to be really easy to find this. Johns Hopkins used to pay, and may still, pay the full premium for their people. And then their deductible was only $100, $300 if you have a family. And their out-of-pocket maximum, the most you would ever pay in a year, was $3,000. For the most part, probably their residents never met it unless they had a scheduled surgery or something like that. On the other hand, a lot of places will do cost sharing. By the way, if you have a family, 32 out of the 186 covered the kids. What you'll see less, actually I was surprised here, 32 covered the resident and the spouse, and then usually we cover like the whole family plus the spouse and kids, that same 32. But for the most part, what you're going to see offered if you have a family is they're going to cost share the premiums and the cost of your insurance. So they're paying part of it, you're paying part of it. And they'll do it for the resident, and they'll do it also for any kids. What they won't do it for, and what they won't pay for typically, although they will offer coverage, just not at a subsidized rate, is they're going to offer your spouse. They're not going to offer your spouse subsidized coverage. Some places do, most places don't. Just tends to be the trend these days, and it makes sense. Most insurance companies say that if your own employer offers you insurance, you have to take that. and that works for your spouse. So if your spouse is working, they're expected to take their own insurance from their employer, which is likely subsidizing, they're fully paying it. And with both spouses working in most households these days, well, they're just trying to save a little bit of money on the residency side and cuts their cost. Not as much of a benefit to y'all, but that's how it works. And again, they'll cover the kids. They won't usually cover the spouse, although if they do, great. Um, and so just a couple of examples. You can see Hopkins here. We've already talked about that one. Then we've got MUSC, which is actually the state health plan. It's the same one I'm on, that every state employee is on, or we have options, but it's the one that most of us are on. And you can kind of see how this works. As an individual, you'll pay $98 a month for your health care or for your health insurance. And then after you pay $490 for you, $980 for your whole family combined, they'll start covering 80% of the cost until you hit $2,800 out of pocket for you, $5,600 for the whole family. And then they'll start covering 100% after that. Vandy looked actually pretty similar to this. It was a PPO program. They covered employees and they covered kids. Deductibles were a little bit higher. Out-of-pocket maximums were much higher. So if you are going there ranking that high, it's just something to factor in terms of your budgets and everything there. Still a great program. The insurance coverage still isn't bad. It's just know that you're going to have to pay a little bit more out of pocket before they're going to start covering anything, and that your worst case scenario is a little bit higher than other options. Of course, that's even still lower than others. Again, most offer healthcare on day one. Past day one, like 99% offer some sort of healthcare. Most are going to offer prescription coverage. What I have found actually to be the most important, just looking at the healthcare demographic, is the behavioral and mental health coverage. A few years ago, the last time they ran this prior to the 2018-2019 graduating class, the last time they ran this was about 5 years before that, and the numbers were much lower on this. So we're seeing insurance cover and understand that behavioral and mental health needs to be covered, is actual health care, as well as substance abuse treatment. And most of you are looking at that right there, and you're like, well, I got no problems with that. Speaking from looking at the data, as well as speaking from a member of a family with people who have been in healthcare field, it's a big issue. Both mental health, if we're talking about burnout and things like that, and substance abuse is a huge issue in healthcare. You'll probably already know this. I can speak from experience that 100% of my family that has worked in healthcare has actually ended up with substance abuse problems. That's not to say that's the same for other families. That's not to say that's the same for all of y'all. But having that care, having that included in your insurance is a really, really important thing, because we do see higher rates at healthcare institutions. All right. So before we start looking at some of the other trends and the other pieces of insurance, you need to know how to budget for healthcare, budget for insurance and things like that. So I like making a spreadsheet. You can do it some other way if you want. You can do it on paper. People do it on a napkin, but I prefer a spreadsheet. And you need to be really honest with yourself. Go back and look at the past few years. How much of a healthcare consumer are you? How often do you go to the doctor's office? How often have you stopped by to ask, one of the doctors that teaches you a question? Well, that would be a doctor's office visit probably in the future. So you need to evaluate that and be pretty honest about it. Then I want you to add 2 doctor's visits. Sorry, y'all are getting older. The older we get, the more doctor's visits we go to. When I was your age, I don't think I went to the doctor hardly at all, if maybe none for like the 4-year period of school. Then you need to run the numbers. So remember, normal number of visits, add 2, then run the numbers. And then you need to think about, okay, is this going to still be accurate? Have I been rationing care while I was in school? Because, hey, the school insurance is okay, but it's not great. Maybe my parents' insurance that I've been on is okay, but not great. Or I just couldn't afford the copays and things like that. Have I been rationing care? Have I been putting off something? Hey, my knee's been bothering me for a few years. My shoulder's been bothering me for a few years. I should probably go have that looked at once I have insurance. Well, that's going to be something to factor in here. Um, is there any major expenses that I'm expecting? Hey, I have been putting off a surgery to fix my knee because I can manage while I'm in school, but not so much while I'm a resident. Or hey, been planning on starting a family, been putting it off while in med school. Now's the time. Well, factor those into your costs because it's going to be a cost for any of those scheduled surgeries, any growing a family. And you have to look at your benefits package to see how they cover those certain types of things. And for us, I would say anytime we're looking at growing the family, we always expect to pay the out-of-pocket maximum for my wife's coverage. And after that, anything she needs is going to be free, which is kind of great. Good time for her to catch up on anything she's been putting off or go to the chiropractor and things. All right, dental coverage. Highly, highly important. We know from looking at the data that people who have poor dentition tend to have worse health care or worse health overall in a lot of ways. That includes the rest of us too. It's not just our patients. So only 25% of places are going to offer coverage and pay for it all. It's rare to see that. Kind of an interesting thing here at the state, they do offer basic dental coverage for free, so MUSC would qualify for that. On the other hand, most places, and this doesn't include that first 25, so 71% of places are going to offer a plan that you can pay for. General rule of thumb is to take that plan and pay for it. 4% aren't going to offer anything. See what you can find out there in the market. There are some outside dental coverage, outside dental insurance. Especially if you've been putting off some work. That stuff gets real expensive. So you need to look at what's covered. And at what level are they covering it? Do they cover like a level 1 dental cleaning or not a level 2 or, things like that. Things that quite frankly, I don't understand fully. Or they cover dental cleanings up to this dollar amount and you pay what's left and that sort of thing. Have to get a filling. Do they cover the new ones that actually look like part of your tooth, or do they only cover the old silver fillings and that sort of thing? Or do they cover that part, the better ones partially and not fully? What isn't covered? Especially for those of you with families, check and see if things like orthodontia are covered. That's a big thing for those of us with kids. And most dental insurance isn't going to cover that. So just look at that, consider, what do they cover? What do they not cover? How much am I paying each month for it? So what are my premiums? And you should find out if there's some sort of a secondary coverage. I've got an example from mine out here, and MUSC is what it says there, but it's state health plan. And they offer a secondary insurance. So the primary dental insurance, quite frankly, it sucks. It covers almost nothing. So for my family, it's worth paying for the extra dental plus because if I'm being honest, one trip to the dentist a year more than pays for it in the whole year. They'll pay out more than I'll pay into it. There's a lot of us. And that's at $81 a month that I'm paying for my family. For you, you may be fine not having the extra coverage, but you need to look and see what that primary coverage is and how much it covers and what you think you're going to need to have done. If some of you all haven't been going to the dentist in a while, you might look at the extra coverage and add that. Next question is, where can I go? Now, if you're moving to a new area, this isn't quite as important other than just making sure that they're on the list. But maybe you're moving home. Can I go to the dentist that I went to growing up? That's actually something I did when I moved back up here to the upstate. I found my old dentist. Hey, he was still practicing. So I went there. Turns out they weren't covered on the state dental plan or the dental plus. So worked out something with the dentist, and they actually were like, hey, look, we'd love to keep you. This is what we can do. And it basically works like I'm on the dental or like they're on the plan. Old family dentists can do that for you. But you need to know where you can go. If they're not on the plan and they can't work something out for you, well, you might need to find a new dentist, even if you are going home. And you need to know if it's an HMO or a PPO. So again, ours is more like a PPO. So we were getting some coverage paid to the dentist that I go to. But if it was a true HMO, they would have paid nothing at all to this dentist, and it would have been entirely out of pocket if I wanted to stay there. Guess what? I'd have been vamoosing and going somewhere else. Then there's vision coverage. Surprisingly, more places offer vision coverage than dental coverage. I guess they want you to see the actual patients you're working on. Um, but most places, again, if we combine everything here, they're still going to offer some sort of a plan. So, your eyes start getting a little worse, happens as we get older. When I was y'all's age, I didn't have glasses. Guess what? Now I can't drive without them. But 3% of places are still going to say, tough luck. And again, if that's you and you need vision coverage, I would say go look for some outside vision coverage. It does exist. And what you look for is exactly the same thing as you looked for on dental. What's covered? What's it going to cost me? Where can I go? Who accepts my insurance? Can I only go to an optometrist for an eye exam when I prefer to go to an ophthalmologist? That sort of thing. And by the way, trick here. If you go to an ophthalmologist, you don't necessarily have to get your glasses there. You can go somewhere else and get it that might have a coupon or something like that. LensCrafters lately has been really good about sending an extra $50 off coupon that you can use with your insurance, when most coupons that you find for glasses you can't use with insurance benefits. And that's how I almost got these glasses for free. I think I paid like 20 bucks out of pocket for them. You're never actually going to get the free glasses. I've tried for me, I've tried for the kids, for my wife. It never happens. But you can get pretty close to it these days. And then what other coverage is there? We've already mentioned prescription drugs, behavioral, mental health, and substance abuse. But complementary medicine, do they consider offering a gym membership part of medical coverage? That's pretty cool because we know being in shape helps. What else can you see out there? And y'all can see this. Y'all can actually even download the report yourself from the AAMC if you wanted to. But this is here just to kind of give you an idea of what to expect from your residency programs. All right, I'm going to stop sharing for now. I'm going to unmute you all. It's going to take me a second. Or I'm going to give you all the chance to unmute yourself, I should say. And you should see something pop up on your screen as I unmute you. So if you'd like to, you can unmute yourself and ask a question. And I've got all of you now. All right, Dan, I see you popped up here on as turning your mic on.
No, I just unmuted myself just in case I had something, but I can't think of anything.
Okay. Anyone have a question? All right, Brant, you got one?
Yeah, it's kind of a generic question, but like the benefit packages that they've been sending out through email or like within their brochures, the ones that I've looked at, I mean, I haven't dug very deeply into a lot of them yet, but like in general, they list like two or three different plan options with price for the resident, price for family, price for resident plus spouse. But I haven't seen anything that actually breaks down what those plans are in terms of the deductible, the out of pocket. Is that something that we would have to request from the program, or would we go like to that whichever Blue Cross Blue Shield and figure out from there? Like, how would we find all the specifics? I guess.
I would say I'd start first by looking online. Some of the examples I've used in the past, they've taken that information offline. And if they're really wanting you, their residency coordinators will send that information to you. And it's usually not protected information or anything like that. So I would ask them if I can't find it just by looking online.
Okay.
Yep. All right. If there are no other questions, I will move on. And for those of you who didn't unmute yourself earlier or this time, I think you'll still be able to do it later. So back to, make sure I share the right screen. I got 3 screens when I'm sitting here at home. Back to different benefits. So now we get into HSAs and FSAs. This is kind of a real nebulous topic for a lot of people. So just in general, looking at kind of these, without breaking them out, without separating them and talking about the differences at this point, these are savings accounts that are built for specific purposes. So health savings account, it's in the name, that's for health spending. A flex spending account comes in actually different flavors. You've got, a dependent care health flex spending account. You've got the flex spending account for healthcare, and then other ones. We're focusing on healthcare today when it comes to this. So what's it for? And you've got this great little graphic here. You can use it to pay your copays, your deductibles. You can use it to pay for any qualifying prescriptions. So as long as it's on their list, you're good to go. And certain medical equipment. Sorry, not your stethoscope. That's for you to use at the doctor's office, not otherwise. But usually that's going to be something like maybe a CPAP machine, or if you have a child, maybe it's something for like phototherapy if they've got a little bit of jaundice going on. That sort of medical equipment is what, for the most part, you'll run into. And how does it work? So no matter which one of these you're in, the way it's going to work is you're going to contribute out of your paycheck directly to these programs. Usually they're run by the hospital that you work for. And then you pay a bill out of pocket. I've got the asterisk there because there are some that will actually give you an HSA or FSA debit card, which is great. You can pay using that instead of paying out of pocket. But then, kind of works the same way. You submit for reimbursement if you paid out of pocket, and you have to provide them the documentation like, hey, I went and bought Tylenol. That's on your list. It's not even a prescription, but it's on your list. Here's my receipt. Now, if you paid for it with like a debit card sort of thing, the way they're going to do is they're going to actually review it. And before they fully deny it, they're usually going to ask you a question like, hey, you submitted this payment to a healthcare facility. Can you send us some information about it? And then they'll approve it. If they deny it, you end up having to pay it back to the FSA or HSA. Now, how are they different? The way they're different is, first we'll look at a flex spending account. So flex spending account is if your employer offers it, you can sign up for it. The most you can put into it in a year is $2,850. That's brand new information for this year. But here's the thing. This money is owned by your employer. If you don't spend it all, they keep the money. So if you put $2,850 in there, you only spent $100 out of it, you've lost a big chunk of money. FSAs are really good when you have known expenses coming up. The neat thing about an FSA is that because when you sign up, you are signed up to contribute a certain amount for the year, you can actually access those funds early. So even if you haven't contributed to it, but you said, hey, I'm going to contribute $2,850 for the year. And okay, my daughter's birthday was in January 17th. So if I signed up for an FSA, knew I was going to have those expenses in January, even though I haven't contributed them yet, I can access them to pay this off. Now, I still have to keep making my contributions to that. If I leave early, I still have to, if I end the year early with an employer, I have to still pay that back if I haven't met it by the end of the year. But in January, I have access to the full amount that I said I was going to pay for the whole year. Again, there's no carryover. Any leftover funds are forfeit. If you are really, really lucky, your employer might say, hey, you actually have, instead of December 31st, we're going to give you till January 31st. You get an extra month to spend these funds. That's why you see a lot of people buying up all the approved stuff, Band-Aids and Tylenol and ibuprofen and all that stuff, and stockpiling at the end of the year because they've got like an extra 50 or $100 in there they need to spend. And you can't invest this money. Remember, it's owned by your employer. It's not yours when you have an FSA. And HSAs are a little bit different. First, a lot of you are not going to qualify for a health savings account in this sense, or for an HSA. You have to have a deductible that is over $1,300 to qualify for that. Now, if you do, you can contribute up to $3,650 for you, or if you have a family, $7,300 a year. That's this year's limit. This money is yours. It can be invested. It's entirely up to you how you invest it and how it works. And you contribute what you want. You can set it, you can change it during the year in a lot of cases, but you don't have early access to it. You only have access to what's in the fund at the time. Again, You keep the funds at the end of the year. They build year after year after year. They can be invested so they can grow. I would tell you that once you become an attending, if you have access to one of these, it might be something you consider because, and I'm not an expert on this, but people use this in some ways as a tax shelter and as a retirement because you're investing it. You can do it pre-tax, so save a little bit of money on your taxes. And then as long as you don't take it out before you're 65, you can see below there, there's no penalty. On the other hand, if you withdraw money from these accounts early for anything other than a medical cost, they're going to be taxed at your income rate and you're going to have a 20% penalty. Ooh, that gets expensive. So if you're going to use it for an investment purpose and retirement, that also works as a kind of a health savings account, which is what this is. Don't take it out for anything but healthcare until you hit 65 years old. Otherwise, quite frankly, it just costs you too much. So which is better? Do you need one? You can see my opinion on that. It really depends. They become really, really useful. One is a tax structure if you have an HSA, but for an FSA, if you know you're going to have medical expenses, it's great. If you don't know that you're going to have medical expenses, it's a gamble on an FSA. But if I've got recurring prescriptions, and some of them can be quite expensive, if I know that we're growing a family or starting a family, if I know I have a chronic illness that I manage, and that the prescriptions and the number of doctor's visits for that is quite high. If I have any planned procedures coming up, those are great reasons to put money in an FSA. And guess what? If you do it one year, you don't have to do it the next year. And if you don't need the money now and you want a way to invest it, but know that maybe at some time down the road you could have some health issues based on family history, well, then it's a good time to use an HSA. Oh, no, I apologize if anyone has put anything in the chat. I did not have that up. Okay, now the important thing, vacation. Y'all actually in a year will, or not even a full year, y'all will be able to take vacations again. And so that means you do need to budget for it. Let's see if I can get this to, no, it's not showing everything. I may just have to move it on the screen. And when it comes to vacation leave and sick leave and things like that, there's two main ways of thinking, although different places call it different things, but there really is two main ways of thinking. The first way, and this seems to actually be a little bit more rare on the hospital side, is what we would call designated leave time. It's that I have vacation leave, and then over here I have sick leave. You know, they're separated out. The good thing about them is that it protects your vacation time. Some places will still allow you to use vacation leave for sick time, but you know, the idea is that it does protect your vacation time. And there are limits on the types of leave in this case. So, you know, we'll talk about some of that soon, but you know, one type of limit that I have on this, or that I've seen on this, is say family sick leave versus personal sick leave. And they may differentiate that out even further. You know, here at the state, I can take all my sick leave that I want for me. But for my family, I can only take up to 2 weeks, you know, to take the kids to the doctors and things like that. Or, if, you know, like when Christopher was in the hospital, well, guess what? We used our full 2 weeks of family sick leave. And then I had ended up starting to work from home, the new home in the PICU, processing loans while he was still in there and on the ventilator and everything. Because I ran out of family sick leave. On the other hand, then you have undesignated leave time. So this other large category. And PTO is what it's most commonly called, but they may call it just leave. They may call it something else entirely. Pretty much comes down to, like, we don't care why you're not going to be here. That's your business. But we'd like to know ahead of time, but we can. But we don't care why you're not here. Just take leave. Take paid time off. You've got some increased flexibility here. There's not as much designated. They don't care if it's for family. They don't care if it's for you. They don't care if it's vacation while you're out. And if you have it, you can take it. But of course, be a good employee. Request the approval first if it's something that's scheduled. You know, you get the flu, you get COVID. That can't be scheduled. They understand that. And then you need to figure out, how does the leave accrue? There's a few main schools of thought here. Some places leave as soon as you start the new year, you have the full amount of leave you're going to have for that year. They say, okay, it's January 1st, you get 20 days a year. Boom, here's your 20 days. Other places are like where I work, and a lot of the hospitals that you'll work at will say, okay, at the end of a month, each month, you've earned sick leave. So, or you've earned PTO, or you've earned this. So it builds up over the year. Got to be really cognizant of that, especially when you're new somewhere, and know how that leave is going to work. You may not be able to take a vacation after you've been there a month, even though, hey, they'll approve the time off. You just got to take it without pay because you haven't accrued much leave yet. The next thing to know is there a cap? Oh, I'm sorry, I skipped it. Does it roll over? If you don't use it all in a year, what happens to it? Do I get to keep it? Does some of that roll over? And is there a cap on what rolls over and what I can actually have essentially in my leave account at the time? I'm giving you all my example. The saddest thing in the world is when you get to the end of the year and you have lost leave because you didn't take it all. They factor it into your pay. They consider leave part of your pay. So you are paid to take that leave. Guess what? If you hit a cap, which for us is 45 days at 7.5 hours a day, that's 337.5 hours. Anytime I see that on my carried forward hours, that means I probably lost some leave, or I did it perfectly. Well, guess what? I lost some leave last year. It was a really sad thing. And that's how our annual leave works. Our sick leave works a little bit different. We can accrue, I think, up to 2,000 hours of sick leave, which totals pretty much a whole year. Right now, I'm just sitting at 6 months sick leave. So when I go to retire in 12 years or so, I'm going to be out for 6 months for mental health. No, I'm kidding. But other things to know. If you don't use your leave, can you get paid for it? Some places will allow this, other places will not. Where I work, doesn't. Where you work, may. If you can get paid for leave that you're going to lose anyway, well, guess what? That's a bonus right around December for most of you, or maybe it's around June 30th, and maybe that's how you're going to pay for next year's vacation, is getting paid for unused sick leave. Because in some of y'all's cases, that may be a lot of leave. In other of y'all's cases, you'll have 0 leave left, which is totally fine. Because you've used it all. And then when I say that some places get really, 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 really specific, this is what USC does. This is all the different types of leave, and you'll notice that there's a scroll bar there. So it goes down, and you can take even other leaves. And they've actually, since I took this picture, they've added new types of leave. So, they can get super, super specific. Just as an example, most places aren't that bad. So what's typical? You can see here on the screen how many places give sick leave, how many places give paid time. For the most part, if you look at it, you're going to have at least 22 days off, not counting your weekends. This is paid time off. You may not get weekends anyway, your residents, or you will be. But for the most part, you're going to get at least 22 days, but the bulk actually give 29 or more days in terms of paid time off. How it's broken down is going to depend by where you are. And it's difficult for places that do PTO to answer these breakdowns accurately because, well, it's PTO. It's not designated annual vacation. It's not designated sick days. That's why a lot of them are answering 0 on there, because realistically, it's all one type of leave at a lot of places. But unless you're at like 2% of residency programs, and even these have gotten better, or they just reported wrong, you're going to at least get a vacation. You're going to at least get days off. So now that you're going to get a vacation, start budgeting for it. You're going to have an income. You're going to be making like 60 grand a year. That's more than the national household income or average income. Y'all are going to be doing all right. Got some student loans to pay for and things like that, but we're gonna manage that in another talk. So thinking about starting a family at some point, you can see here who offers fully paid maternity leave, who offers cost share maternity leave. What that basically means in terms of cost share is you get paid a reduced salary. But if you have short-term disability, well, guess what? You can use that to cover part of your maternity care. Paternity care works the same way. except it's more on, you're not going to be likely to be able to use short-term disability for that. What else do they offer? You need to look at that, and you need to know the way it works, as well as how that can affect your residency training program. For the most part, I would say most residency programs are built that if you choose to start a family while you're in school and have one child, you're going to be okay. You're going to be able to graduate your residency program on time. If you have 2 or more children while in residency, hey, maybe that's a long program. Likely you're looking at delaying your graduation from that residency program a little bit, but not significantly. We're not talking a whole year or anything like that. All right. What else should you look for? Retirement. That's a really big thing. The unfortunate thing for residency, close to half of places are not going to offer any match on your retirement. They may offer a plan, and most are going to offer a plan, but what we're really looking for is the match on that. So if they're offering a match, you want to take their full match. If they're going to match 10% of your salary and you put that all into retirement, guess what? I'm getting a little less Starbucks for the month, and I'm putting the extra into my retirement, because that's like I got a 10% raise without doing anything. We'll cover more on that on March 15th when Sam comes to talk to y'all. You're going to get raises every year. That's a given in residency. And like I said, you're going to start out, most of you, close to 60,000, depending on where some of you go. It may be more. Usually it's more where the cost of living is higher. So it tends to even out or come close to it, unless we talk, New York or San Francisco. Those are expensive. Even with the higher pay and other benefits, it's still very, very expensive in those areas. But what else are they offering? Are they going to give you time off to go to conferences? Are they going to help you pay for those conferences? Great way to get out there, especially if your employer is going to pay for it, is to go do conferences, go present research, go do all that fun stuff, things you've been doing already anyway. And hey, paid trip. And usually they'll even pay for your food and everything while you're out there. So you end up a little bit cheaper by letting them pay for everything. What about childcare? Do they offer things on site? Is it subsidized at all? Things like that. Like Prisma has the on-site childcare for their employees. Great. What's it cost? I don't have a clue. We don't qualify for it because I work for the state, not Prisma. But likely it's subsidized to some extent by the hospital system. That's somewhat typical, that they're paying for some of it just to keep the cost affordable for their employees. I can tell you, usually those are really good childcare facilities. I grew up going to the one at Spartanburg Regional. It was great. A lot of fun. Then there's other benefits, and y'all, were almost done, so thanks for bearing with me. Are you going to have financial counseling available? The good news is most places offer it. 75% of places offer some sort of a financial counseling. Most of the time that means that they more or less pay a retainer to a local financial counseling firm, and you can call them and get advice from them free of charge. Guess what? If they don't have it, or if you still want to call me, call me. I'm still your guy until I retire for 12 years, or in 12 years. And all of you will be out of debt entirely at that point. So y'all will be good. Y'all will be done at that point. What else do they cover? They cover your books that you need. Any phones? The phones is a good one these days. Do they? You walk in on day one, do they hand you a nice brand new iPhone? Those are pricey. Do they offer a computer that you can take around with you? Well, they want you to work. They want it to be more convenient. A lot of places are going to offer some sort of a computer. What about meals? Y'all, this is an important one. You spend most of your time in residency at work. Sorry, it's honest. So do they cover meals? Is it only while you're on call? Do you have a stipend? Or are all meals covered while you're at the hospital? Different places have entirely different policies on this. Maybe they don't cover anything. Do they cover moving expenses? Well, find out. Some places just give you a flat $2,000 check and say, here, move. Other places will say, hey, we'll reimburse you up to this amount, so send us the receipts. I prefer the ones that give you the straight up check because if I can move cheaper, that's money in my bank account. What about parking? Is parking free? Do they subsidize your parking? Find out. Around here in Greenville, we're pretty spoiled. Parking for the most part is free or really cheap. Some of the bigger cities, $300 a month. Some places are more expensive. It's like paying a second rent payment just to be able to park a car. Do they offer scrubs, or am I going to have to buy my own? All of that sort of thing. The key thing here is with any benefits that they are offering you, you need to consider taking advantage of it. Maybe it's not for you. That's okay, but at least consider it. It's like I tell you all about going to EAP. Look, you've already paid for it. In the case of your employer benefits, they consider it part of your pay. So, even though they're paying you, I've attended some meetings recently where folks have been talking about this, and they factor in things costing about $100 per resident to provide all their benefits and everything. Well, guess what? Y'all are only making 60 of that. So the rest is all these other things that they're paying for. And they factor it in. They budgeted for it. They accounted for it. It's part of your pay. It's part of your package. Go take advantage of it if they offer it. At least if it's something you're interested in. All right. So there, I cited my sources. And I'm going to stop sharing now and unmute y'all again. So does anyone have any questions? You can also post them in the chat. I've still got that up. All right, I think everyone has a chance to unmute if they want to. If not, oh, go ahead, Danetta.
Hi. So I guess I have a question. So will we just ask the program? Okay, we would look online, and if we don't find this information online, then we would reach out to the program coordinator, or should we find like a resident to ask?
No, I'd reach out to the coordinator.
Okay.
If you ask a resident, you may and may not get the information, or you may and may not get accurate information. It won't be intentional on their part. It's just maybe they have wrong information in their head, or they don't understand how the healthcare actually works.
Okay, sounds good. Thank you.
You're welcome. I'd also tell y'all that as you start getting these benefits packages especially after the match, and they're making you pick a program and pick which one you want to be in, by all means, bring it by my office, which, by the way, now is on the 3rd floor and will be until April. So bring it by. We'll take a look at it together. If you're looking at it now, you want me to help you break a tie, bring all the information by and we'll look at it together. But if there are no other questions, I will end this and y'all will get about 4 minutes back in your day from the scheduled time.
Thank you so much.
Oh, my pleasure. And those of y'all that have been here today, by the way, you will get a second dose of this, abbreviated and slightly different, come intensification. Brant, go ahead.
I just want to say thanks for your time.
Oh, my pleasure. This is one of the fun ones to do. By the way, we've also got a home building workshop coming up, so watch your emails for that. I know a lot of y'all are thinking about, or home buying, not building, home buying workshop. So if y'all are thinking about buying a house, keep your eye out for that email. Thanks, y'all. I will watch it, Danetta, at some point. Take care, y'all.